Hey there, and welcome back to the show. Today, we're diving into one of the most eye-opening books about money I've ever read. And here's the thing, it's not really about money at all, at least not in the way you might think. We're talking about The Psychology of Money by Morgan Housel. And if you've been listening to this podcast for a while, you know I don't throw around praise lightly. But this book, it changed the way I think about wealth, happiness, and financial decisions. Now, before you worry that this is going to be another boring finance lecture full of compound interest calculations and investment jargon, relax. That's not what this book is about. And that's not what we're doing today. Instead, we're going to explore something much more interesting. We're going to talk about why smart people do dumb things with money, why your brother-in-law, who's great at math, can't seem to save a dime, why some people get rich and stay rich, while others make millions and lose it all. So grab your coffee, get comfortable, and let's talk about the psychology of money. The big idea. So let's start with the central thesis of this book, because it's brilliant in its simplicity. Morgan Housel argues that doing well with money has little to do with how smart you are and a lot to do with how you behave. And behavior is hard to teach, even to really smart people. Think about that for a second. We spend years in school learning math, reading, science. Some of us go to college and study finance or economics. We read books about investing. We follow the stock market. We think if we just learn enough, if we just get smart enough about money, we'll be successful. But Housel says that's not how it works, because finance isn't like physics or engineering. You can't just study the formulas and apply them. Why? Because money is deeply personal. It's emotional. It's psychological. He opens the book with this powerful observation. He says that in physics, if you calculate that something should happen a certain way, it happens that way every time. 1 + 1 always equals 2. Gravity always works the same way. But with money, people don't behave like spreadsheets. We're irrational. We're emotional. We make decisions based on our unique experiences, our fears, our hopes, our egos. And here's what really blew my mind. Housel points out that we've only been studying personal finance academically since the 1960s. Before that, there wasn't really such a thing as personal investing for regular people. Your average person didn't have a retirement account or a stock portfolio. So we're all kind of making this up as we go along. That's why this book isn't about tips and tricks. It's not about which stocks to buy or how to time the market. Instead, it's about understanding yourself, understanding your relationship with money, understanding why you make the choices you make. We're going to walk through the key lessons from this book, and I promise you, by the end, you'll think about money differently. Not in a depressing way, actually, in a really freeing way. Ready? Let's dive in. Lesson 1. No one's crazy. Now, you might be thinking, wait, what? I know people who are absolutely crazy with money. My cousin who keeps dumping money into cryptocurrency schemes, my friend who won't spend a dime on anything, my neighbor who bought a car he definitely can't afford. But here's what Housel means. Everyone makes financial decisions based on their own unique experiences with how the world works, and those experiences are different for everyone. He tells this story in the book that really drives this home. Imagine two people are born in the same country, just a few years apart. But one is born in 1940 and one is born in 1950. The person born in 1940 experiences their young adult years in the 1960s. They see the stock market go basically nowhere for a decade and a half. Inflation is high, interest rates are climbing. For them, stocks seem like a terrible investment. But the person born in 1950, they hit their 20s in the 1970s and early 80s. They witness the greatest bull market in history. They see stocks multiply in value. For them, stocks are obviously a great investment. Same country, just 10 years apart, but completely different worldviews about how money works. Or think about this. If you grew up during the Great Depression, you watched people lose everything. You saw banks fail. You saw wealthy families reduced to poverty. Of course, you're going to be extremely conservative with money. Of course, you're going to save every penny. Of course, you're not going to trust the stock market. But if you grew up in the 1990s, you've seen mostly good economic times. You've seen technology create millionaires seemingly overnight. You watched your parents' home value triple. Of course, you're going to be more comfortable taking risks. Neither approach is crazy. They're both rational responses to lived experience. Housel says we all think we know how the world works, but we're actually all just guessing based on our own limited experience. And the more extreme your experience, the more likely you are to have extreme views about money. This is huge when you think about it. It means that your grandmother who hoards cash isn't irrational. Your friend who day trades isn't stupid. Your colleague who refuses to invest isn't crazy. They're all making decisions based on what they've learned about how the world works. And here's the kicker, you are too. Every financial decision you make is influenced by your unique experiences, the economy you grew up in, what your parents taught you, whether you've experienced job loss or wealth or poverty. It's all shaping your behavior, often without you even realizing it. So the first step to getting better with money, recognize that your experiences aren't universal. What seems obvious to you might seem insane to someone else, and vice versa. And that's okay.
Lesson 2. Luck and Risk. All right, next up, let's talk about luck and risk. And this might be the most uncomfortable lesson in the book. Housel argues that nothing is as good or as bad as it seems. And the reason is because luck and risk are two sides of the same coin. They're both real, they're both powerful, and they're both often invisible. He starts with this story about Bill Gates. Now, we all know Gates is brilliant, right? He's a genius programmer, he had vision, he worked incredibly hard, he built Microsoft into one of the most valuable companies in the world. But here's something you might not know. When Bill Gates was in high school, his school had a computer club. In 1968. Think about that. How many high schools in America had computer clubs in 1968? Basically none. It was 1 in a million. And it wasn't just that they had computers, they had a time-sharing system that gave students access to a real computer. Gates spent hours and hours programming as a teenager, getting experience that almost no one else his age could get. Without that, does Bill Gates still become Bill Gates? Maybe. He was obviously talented, but that extraordinary luck gave him an extraordinary head start. Now, here's the darker side of the same story. Bill Gates had a close friend in that computer club. His name was Kent Evans. By all accounts, Evans was just as smart as Gates. They were best friends, they programmed together, they had plans to start businesses together. Kent Evans died in a mountaineering accident before graduating high school. Same school, same computer club, same opportunities. Gates got lucky. Evans got unlucky. That's it. That's the difference. And Housel says this is true across the board. When we see people succeed, we tend to focus on their decisions, their skills, their intelligence. We create these stories about why they succeeded, but we often ignore the role of luck. And when we see people fail, we do the same thing. We focus on their bad decisions, their mistakes, but we ignore the role of risk, of bad luck, of things outside their control. Now, why does this matter? Because if you don't recognize the role of luck in success, you're going to try to copy behaviors that might have only worked because of lucky circumstances. You'll take risks that aren't actually smart. And if you don't recognize the role of risk in failure, you're going to be too harsh on yourself when things don't work out. You'll think every setback is your fault, when sometimes it's just bad luck. Housel puts it this way. Be careful who you praise and admire. Be careful who you look down upon and wish to avoid becoming. This doesn't mean skill and decisions don't matter. They absolutely do, but they're not the only things that matter. Luck and risk are always in the mix. Always. So what do you do with this? How do you make decisions when luck and risk are real? Housel says the key is to focus on what you can control, but stay humble about the role of randomness. Make good decisions consistently, but don't assume that because something worked once, it will work again. And don't beat yourself up when you make good decisions that lead to bad outcomes. That's just risk. That's just life. Lesson 3. Never enough. Okay, let's shift gears. Let's talk about one of the most powerful lessons in this book. Never enough. Housel tells the story of two men, Rajat Gupta and Bernie Madoff. If you're not familiar, Gupta was the head of McKinsey, one of the world's most prestigious consulting firms. Madoff ran the largest Ponzi scheme in history. Both of these men had more money than they could spend in multiple lifetimes. Gupta was worth over $100 million. Madoff was a billionaire. And yet, both of them risked everything for more. Gupta got caught insider trading. Madoff built a massive fraud. Both ended up in prison. And Housel asks this question: at what point is enough enough? Here's the thing. There's no reason to risk what you have and need for what you don't have and don't need. Sounds obvious, right? But people do it all the time. They have a good job that pays well, but they risk it by cutting corners or behaving unethically because they want a promotion. They have a comfortable nest egg, but they gamble it on a risky investment because they want to get rich faster. They have a happy life, but they sacrifice their health and relationships because they want more money. Housel argues that the hardest financial skill is getting the goalpost to stop moving. We get a raise, and suddenly we need a nicer car. We get that car, and now we need a bigger house. We get the house, and now we need a vacation home. It never stops. And here's the psychology behind it: social comparison. We don't measure our wealth in absolute terms, we measure it relative to the people around us. Your friends, your neighbors, your colleagues, the people you see on social media. If you make $100,000 a year, but everyone around you makes $200,000, you feel poor. But if you make $50,000 and everyone around you makes $30,000, you feel rich. Same you, same money, different feeling. This is why, and Housel really emphasizes this, the only way to know how much is enough is to decide for yourself. You have to define your enough. Not based on what other people have, not based on what's possible, based on what you actually need to be happy. And once you hit that number, stop. Stop moving the goalpost. Appreciate what you have. Protect it. Don't risk it for more. Because here's the thing, the ceiling of social comparison is so high that virtually no one reaches it. There's always someone richer, always someone with more. If you're playing that game, you'll never win. You'll never have enough. But if you defined enough for yourself, you can win. You can actually reach it. And then, and this is the beautiful part, you can stop stressing about money and focus on the things that actually make you happy. Housel sums it up perfectly. The only way to know how much food you need is to eat until you're not hungry. But money is different. With money, you need to consciously decide when you're full. Otherwise, you'll keep eating forever.
Lesson 4. Confounding compounding. All right, let's talk about one of the most misunderstood concepts in all of finance: compound interest. Now, I know what you're thinking. Oh, I know about compound interest. It's when your interest earns interest. Got it. But Housel argues that we don't really understand it. We can't. Our brains aren't wired for it. He tells the story of Warren Buffett, who's worth something like $100 billion now. But here's a crazy fact. Warren Buffett's net worth when he was 50 years old was only about $400 million. That's a lot of money, don't get me wrong, but it's less than 0.5% of his current wealth. So when did most of Warren Buffett's wealth accumulation happen? After he turned 50. Actually, most of it happened after he turned 60. Buffett started investing seriously when he was 10 years old. He's in his 90s now. That's over 80 years of compounding. And the majority of his wealth came in the last few decades. Housel's point is this:
Buffett is a great investor, sure, but there are lots of great investors. What separates Buffett isn't just that he's a good investor, it's that he's been a good investor for an incredibly long time. It's time, not genius, that did most of the heavy lifting. Think about it this way. If Buffett had started investing at 30 instead of 10 and retired at 60 like most people, he'd be worth a tiny fraction of what he's worth now. Not because he's less skilled, just because he'd have less time for compounding to work. This is what Housel calls confounding compounding. It's so powerful, but it works so slowly that we underestimate it. We want results now. We want to see our money double in a year or 5 years. But real wealth? Real wealth takes decades. And here's why our brains struggle with this. Compound growth is exponential, not linear. In the early years, it looks like nothing's happening. You invest $1,000, and after a year at 7% growth, you have $1,070. $70, big deal, right? But if you keep that up for 50 years, that $1,000 becomes over $29,000. Most of that growth happens in the last 10, 15 years. But you have to survive the first 35 years of seemingly slow growth to get there. Housel says that good investing isn't about making brilliant decisions. It's about consistently not screwing up for decades. It's about being patient. It's about not panicking when the market drops. It's about not chasing hot stocks. It's about being boring, steady, and consistent for a very, very long time. And this applies beyond just investing. It applies to your career, to your skills, to relationships. The most powerful things in life compound slowly. We live in a world that celebrates overnight successes, but real success is usually the result of decades of consistent effort that nobody sees. So the lesson? Start early, stay consistent, and then, and this is the hard part, be patient, really patient, decade after decade patient, because that's how compounding works, slowly, then all at once. Lesson 5, Getting Wealthy versus Staying Wealthy. This next lesson is one of my favorites because it completely changed how I think about success. Housel argues that getting money and keeping money are two completely different skills, and just because you're good at one doesn't mean you're good at the other. Getting wealthy requires taking risks, being optimistic, and putting yourself out there. You have to believe things will work out. You have to try new things. You have to be aggressive, at least to some degree. But staying wealthy, that requires the opposite. It requires humility and fear that what you have can be taken away. It requires frugality. It requires accepting that you've succeeded, and now your job is not to screw it up. Housel talks about how many people who get rich lose it all. Lottery winners, professional athletes, entrepreneurs who made it big. Why? Because they were great at the skills required to get wealthy, but they never developed the skills required to stay wealthy. Think about it. The mindset that helps you take a business risk and succeed is very different than the mindset that helps you preserve that success. One requires optimism and aggression. The other requires pessimism and defense. And this doesn't just apply to getting rich, it applies to getting any goal. Getting in shape requires different skills than staying in shape. Getting a job requires different skills than keeping a job. Starting a relationship requires different skills than maintaining a relationship. But back to money. Housel says that staying wealthy requires a combination of frugality and paranoia. You need to live below your means. You need to save a cushion. You need to plan for things going wrong because eventually they will. He talks about this concept of survival. In investing, in business, in life, survival is the name of the game. If you can just stay in the game long enough, you benefit from compounding. You weather the storms. You're still there when opportunities arise. But if you're too aggressive, if you take on too much risk, if you spend everything you make, eventually you'll get knocked out. You'll be forced to sell at the worst time. You'll miss the recovery. You'll be done. Housel puts it this way. You have to plan for the plan not going according to plan. You have to have margin for error. You have to assume that things will go wrong, probably multiple times, and you need to be positioned to survive that. This is why he argues against trying to maximize everything. Don't try to squeeze every dollar of return. Don't leverage yourself to the max. Don't assume everything will work out perfectly.
Instead, aim for pretty good returns with high certainty that you'll survive. That's the better strategy. And on a personal level, this means living below your means, having an emergency fund, not keeping up with the Joneses, not buying the biggest house you can afford or the fanciest car. Because when the unexpected happens, and it will, you need to have buffer. You need to have options. Getting wealthy is about taking smart risks. Staying wealthy is about paranoia and frugality. Both are important, but don't confuse one for the other.
Lesson 6. Tails, you win. Okay, this next concept is a bit counterintuitive, but stick with me because it's really important. Housel talks about the power of tail events. In statistics, a tail event is something that's on the extreme end of outcomes, the rare stuff, the outliers. And his argument is this: you can be wrong half the time and still make a fortune. How? Because in investing and in life, it's the tails that matter. He gives this example. Venture capitalists, the people who invest in startups, are wrong most of the time. Most startups fail. A venture capital fund might invest in 20 companies, and 15 of them fail completely. 3 do okay. 1 does great, and 1 becomes the next Facebook or Google. That one success, it pays for all the failures and then some. That's a tail event. Or think about art. Most paintings an artist creates are forgettable, but 1 or 2 masterpieces, those define their career. Or books. Authors write many books. Most sell a few thousand copies, but if 1 becomes a bestseller, it makes the author's career. Or even in your career, you might work on hundreds of projects, but a handful of key wins matter way more than all the others combined. Housel applies this to investing. He points out that in the stock market, a small number of stocks account for most of the market's returns. Most stocks just kind of go sideways or down, but a few become Apple or Amazon or Microsoft, and those few make all the difference. This is why trying to pick individual stocks is so hard. You have to get those tail events right. You have to identify the big winners, and most people can't do that consistently. But here's the good news. If you buy the whole market through an index fund, you're guaranteed to capture those tail events. You'll own the big winners without having to pick them. Sure, you'll also own the losers, but that's okay, because the winners more than make up for it. The lesson is this: don't be afraid of having some failures. Don't expect everything to work out. Instead, accept that many things won't work out, but focus on creating opportunities for tail events to happen in your favor. In investing, this means diversification. Own many things so you capture the big winners. In your career, this means trying multiple things. Take on different projects, build different skills. You don't know which opportunity will be the one that changes everything. In business, this means experimenting. Launch multiple products, try different strategies. Most will fail or do okay, but 1 might be a home run. Housel says we have this expectation that we should be successful at everything we try, but that's not how success works. Success is about maximizing the number of at-bats you get, so you increase your chances of hitting a home run. And when you do hit that home run, that tail event, it makes all the strikeouts worthwhile. Lesson 7. Freedom. All right, we're about halfway through, and I want to talk about what might be the most important lesson in the entire book: freedom. Housel argues that the highest form of wealth is waking up every morning and saying, I can do whatever I want today. Not money, not possessions, not status. Freedom, control over your time. He cites research showing that having a sense of control over your life is one of the strongest predictors of happiness, more than income, more than possessions, more than achievement. The ability to do what you want, when you want, with who you want, for as long as you want. And money's value isn't in the stuff you can buy, it's in the control it gives you over your time. Think about it. What do people want when they want more money? They say they want a bigger house, or a nicer car, or fancy vacations. But dig deeper, and what they really want is the feeling those things give them. Often that feeling is security, or freedom, or control. But here's the irony.
People often sacrifice their freedom to get the things they think will make them happy. They take a higher-paying job with longer hours. They buy a bigger house with a bigger mortgage, forcing them to work more. They get trapped on a treadmill, earning more but actually having less control over their time. Housel shares this story. In 2007, at the peak of the housing bubble, he had a friend who was a real estate agent making a ton of money, 6 figures easily. But he worked constantly. Nights, weekends, whenever clients needed him. He had no control over his schedule. And Housel thought to himself, I make less money than him, but I wouldn't trade places because I have control over my time. Fast forward a few years, the housing market crashed, the friend's income disappeared, and all those years of working nonstop, of having no time for family or hobbies or rest, they didn't build anything lasting. The point is this: the ability to do what you want, when you want, for as long as you want, has an infinite ROI, return on investment. And you don't need to be rich to have some level of freedom. You just need to make choices that prioritize control over your time. Maybe that means living below your means so you have savings and don't live paycheck to paycheck. Maybe that means choosing a job that pays less but has better hours. Maybe that means saying no to upgrades and purchases that would require you to work more. Housel says using your money to buy time and options is the highest dividend money can pay, more than any stock, more than any investment. And this resonates with me so deeply because I think about what I actually want from money, and it's not stuff, it's peace of mind. It's the ability to spend time with people I love. It's the freedom to work on projects I find meaningful. It's not having to worry constantly about paying bills. So the question isn't, how much money do I need to buy everything I want? The question is, how much money do I need to have control over my time? And often, that number is way lower than you think.
Lesson 8. Man in the Car Paradox. Let's talk about status, because this is where a lot of us go wrong with money without even realizing it. Housel shares this observation he calls the man in the car paradox. Here's how it works. You see someone driving a beautiful, expensive car, a Ferrari or a Lamborghini or whatever, and you think, wow, that person must be really successful. I admire them. But here's the thing. When someone is driving a fancy car, they think people are looking at them with admiration. But people aren't admiring the driver. They're imagining themselves as the driver. They're thinking, if I had that car, people would admire me. In other words, no one is thinking about you. They're thinking about themselves. Housel says this is a fundamental misunderstanding of how people think. We buy expensive things because we think they'll make other people think highly of us. We want respect and admiration. But the fancy car, the big house, the expensive watch, they don't actually generate the respect we're looking for. You know what does generate respect? Kindness, humility, empathy, intelligence, humor, integrity. But those things don't cost money. Actually, they're often more prevalent in people who aren't obsessed with showing off wealth. Think about the people you truly respect and admire. Are they the ones with the most expensive stuff? Or are they the ones who are good people, who've accomplished meaningful things, who treat others well? I'll bet it's the latter. Housel isn't saying you shouldn't buy nice things. If you love cars and you can afford a nice car, great, buy it and enjoy it. But buy it because you love it, not because you think it will make other people admire you, because it won't. This is such a trap, and so many of us fall into it. We work ourselves to death to afford a lifestyle we think will impress others. But those others aren't even paying attention. They're too busy trying to impress us. It's this endless cycle of trying to impress people who are trying to impress other people. Nobody's actually impressed. Everyone's just stressed and in debt. Housel suggests an alternative. Live below your means. Build wealth quietly. Focus on financial independence, not appearances. And you know what's funny? The people who do this, who live modestly despite having money, they're often the ones who actually are admired.
because they're not playing the status game. They're not trying to prove anything. And there's something really respectable about that. So next time you're tempted to buy something to impress other people, remember, they're not thinking about you. They're thinking about themselves. And that expensive thing won't buy their respect anyway.
Lesson 9. Save money. Okay, let's talk about something simple but profound. Saving money. Now, I know, just save money sounds like the most boring, obvious financial advice ever. But Housel approaches this differently. He argues that building wealth has little to do with your income or investment returns and lots to do with your savings rate. Here's why. Your savings rate is the one thing you have total control over. You can't control what the stock market does. You can't control inflation. You can't always control how much you earn. But you can always control how much you save. And here's the beautiful part. You don't need a specific reason to save. Housel argues against the traditional advice of having specific goals for your savings. Save for retirement, save for a house, save for college. Instead, he says save for a world where no one knows what's going to happen. Save for flexibility, save for options. Save because having savings gives you time and choices are invaluable. Think about it. If you have a year's worth of expenses saved, you have the option to quit a job you hate. You have time to look for the right opportunity instead of taking the first thing that comes along. You can wait out a bad market instead of selling at the bottom. You can take a risk on a business idea. You can help a family member in need. Savings is a hedge against life's inevitable surprises, and life is full of surprises. Housel also makes this point. The value of wealth is relative to what you need. Someone with $1 million who spends $900,000 a year is less wealthy than someone with $100,000 who spends $50,000 a year, because the first person needs to keep earning at a high level to maintain their lifestyle. The second person has built-in flexibility, and flexibility is wealth. He talks about how increasing your savings rate is way more powerful than trying to increase your investment returns. Why? Because trying to get higher returns usually means taking more risk, and more risk means more chance of losing money. But increasing your savings rate, that's guaranteed to work. It's risk-free. If you save 10% of your income and increase it to 15%, you've increased your wealth building by 50%. Good luck finding an investment that guarantees a 50% return without massive risk. And you increase your savings rate by spending less. That's it. Not by earning more, though that helps too, by spending less. This is the unglamorous truth about building wealth. It's not about brilliant investments or hot stock tips. It's about living below your means, consistently, for a long time. Housel says that the world is filled with people who look modest but are actually wealthy, and people who look wealthy but are actually living on the edge. The person with the modest house and the old car might have millions saved. The person with the mansion and the luxury cars might be drowning in debt. Which would you rather be? So the lesson is simple. Save money. Not for a specific thing, but for the optionality and flexibility it provides. Because in a world full of unknowns, flexibility is the best investment you can make. Lesson 10. Reasonable versus rational.
All right. Let's talk about being reasonable versus being rational, and this is a really important distinction that most finance books get wrong. Housel argues that aiming to be mostly reasonable works better than trying to be coldly rational. What does that mean? In academic finance, the rational thing to do is to maximize expected returns, take the optimal amount of risk for your age and situation, never sell during a downturn, never let emotions influence your decisions. But in real life, that doesn't work, because we're not robots. We're humans with feelings and fears and hopes. Housel gives this example. The rational thing to do is to have almost all your money in stocks when you're young, because stocks have the highest long-term returns. But what if you can't sleep at night because you're worried about the stock market? What if you panic and sell everything during a crash? Was that rational strategy really better for you? No, because you couldn't stick with it. The reasonable thing to do in that situation is to have some of your money in bonds or cash, even though the expected returns are lower. Why? Because it lets you sleep at night. It prevents you from panicking and making bad decisions. And over the long run, you're more likely to stick with a reasonable strategy that works for you emotionally than a rational strategy that looks perfect on paper but you can't maintain. Housel puts it this way: the reasonable investors who can stick with their plan through thick and thin will beat the rational investors who pick the theoretically optimal strategy but can't handle the emotional ups and downs. This applies to so many areas. Paying off your mortgage early might not be the mathematically optimal move if you can invest the money at higher returns, but if being debt-free gives you peace of mind, it's the reasonable choice, and peace of mind has value. Taking a lower-paying job might not be the rational financial move, but if it gives you better hours, less stress, and more time with family, it might be the reasonable choice. The point is, don't ignore the psychological and emotional aspects of financial decisions. They matter. Maybe they matter most of all. You have to be able to live with your strategy. You have to be able to stick with it during hard times. You have to be able to sleep at night. If your strategy doesn't allow for that, it's not a good strategy, even if it looks perfect on a spreadsheet. Housel puts it this way: you're not a spreadsheet, you're a person, a story, a collection of experiences and emotions, and your financial plan needs to work for you as a person, not as a theoretical robot. So give yourself permission to make choices that aren't perfectly rational, but are reasonable for you. That's not a weakness, that's wisdom.
Lesson 11. You'll change. This lesson is one that really hit home for me. Housel talks about how we underestimate how much we'll change over time. He cites research showing that people are generally aware that they've changed a lot over the last 10 years, but they underestimate how much they'll change over the next 10 years. We think we're somehow done changing, that who we are now is who we'll always be. But that's not true. Your goals will change. Your values will change. What makes you happy will change. And that has huge implications for financial planning. Think about it. When you're 25, you might be grinding at a startup, working 80 hours a week because you're ambitious and building your career seems like the most important thing. But at 45, you might value time with your kids more than anything. You might wish you had made different choices. Or you commit to an expensive mortgage because you love the neighborhood and the school district for your kids. But 10 years later, your kids are grown and moved out. Now you're stuck with a huge house you don't need and a mortgage payment that limits your options. Housel calls these the sunk cost of your past. You make decisions based on who you are now, and you lock yourself into a life that might not fit who you become. So what do? How do you plan for the future when you don't know who you'll be? Housel's answer is to avoid the extreme ends of financial decisions. Don't stretch yourself to the max to buy the biggest house you can afford. Don't commit to a lifestyle that requires you to keep earning at your current level forever. Don't save so aggressively that you have no life now, assuming that future you will be grateful. Instead, find balance. Save a lot, but not everything. Live modestly, but not miserably. Keep your options open. Build in flexibility. And maybe most importantly, accept that you'll change your mind about things. You might think you want to retire early, but when you get close, you realize you love your work. You might think you need a big house, but later realize you'd rather have a small place and more freedom. You might think you want to leave money to your kids, but later decide you'd rather spend it on experiences. That's all okay. You're allowed to change. But the more you've locked yourself into specific paths with your financial decisions, the harder it is to change course. Housel says that we should avoid extreme ends of financial planning, both the extreme of being too conservative and never enjoying your money, and the extreme of spending everything and having no flexibility. The middle is where you want to be, because the middle gives you options as you change. And one more thing, this applies to your career too. Be wary of pursuing a path just because you've already invested years in it. That's sunk cost. If you've changed and that path no longer fits, it's okay to change direction. Don't let your past dictate your future. Lesson 12. Room for error. Host. Let's talk about one of the most practical lessons from this book, room for error, or as it's sometimes called, margin of safety.
Housel argues that the most important part of any financial plan is planning for the plan not going according to plan. He says that we underestimate the need for room for error because we're too optimistic about how things will go. We create these financial plans that assume everything will work out perfectly. We'll stay employed. The market will perform as expected. We won't have any major unexpected expenses. But life doesn't work that way. Things go wrong. Cars break down. People get sick. Markets crash. Jobs are lost. Plans change. And if your plan requires everything to go right, you're setting yourself up for disaster. So, what does room for error look like in practice? It means not stretching yourself to buy the most expensive house you can technically afford.
Buy less house, so if your income drops or expenses rise, you're still okay. It means having an emergency fund, not just a little bit, like 6 months to a year of expenses. So if you lose your job or have a medical emergency, you have time to figure things out without panicking. It means not investing money you might need in the next few years in the stock market, because what if the market drops right when you need that money? It means not assuming you can work until you're 70. What if your health doesn't allow it? What if you get laid off in your 60s and can't find another job? Housel says that room for error lets you endure a range of potential outcomes, and endurance is what matters. Remember the lesson about survival? You have to stay in the game, and room for error is what keeps you in the game when things go wrong. He uses this metaphor. If you're on a boat and there's a 1% chance you'll hit an iceberg, you need a plan for that 1% chance. Because even though it's unlikely, if it happens and you're not prepared, you're sunk. Literally. That's why he advocates for more conservative financial assumptions than most advisors recommend. Assume you'll get lower investment returns than historical averages. Assume you'll have unexpected expenses. Assume things will go wrong, and plan accordingly. The person with room for error can stay the course during a market crash. The person without room for error is forced to sell at the worst time. The person with room for error can take advantage of opportunities when they arise. The person without room for error is always on the edge, one setback away from disaster. And here's the thing. Having room for error doesn't mean you'll get lower returns. It means you'll be able to stick with your strategy long enough to get the returns, because you won't be forced to make panicked decisions. Housel sums it up perfectly. The most important part of every plan is to plan on the plan not going according to plan. Build in buffers, build in flexibility, build in margin for error, because you're going to need it. Lesson 13. You'll Change, Part 2. I want to come back to this idea of change because Housel has another angle on it that's really important. He talks about this paradox. Long-term planning is essential. Compound interest requires time. Building wealth requires patience. You have to think long-term. But at the same time, you have to accept that your long-term plans will change, that you'll change, that the world will change. So how do you reconcile these? How do you commit to a long-term plan while accepting that you'll change? Housel's answer is what he calls balance. You need to find a middle ground between commitment and flexibility. Commit to the long-term habit of saving and investing, but don't commit so rigidly to specific plans that you can't adapt. Commit to living below your means, but don't commit to a lifestyle so extreme that you burn out. Commit to a career path, but don't commit so deeply that you can't pivot if your interests change. He also talks about how important it is to endure regret. This is tough, but it's real. You're going to make decisions that turn out to be wrong. You're going to pass on opportunities that would have been great. You're going to take chances that don't pan out. That's not a failure of planning. That's just life. You can't see the future. You can only make reasonable decisions based on what you know at the time. And sometimes the reasonable decision doesn't work out. Sometimes you buy a house and the market crashes. Sometimes you pick a career and the industry changes. Sometimes you pass on an investment that would have made you rich. That's all okay. You're allowed to change. But the more you've locked yourself into specific paths with your financial decisions, the harder it is to change course.
Housel says that we should avoid extreme ends of financial planning, both the extreme of being too conservative and never enjoying your money, and the extreme of spending everything and having no flexibility. The middle is where you want to be, because the middle gives you options as you change. And one more thing. This applies to your career too. Be wary of pursuing a path just because you've already invested years in it. That's sunk cost. If you've changed and that path no longer fits, it's okay to change direction. Don't let your past dictate your future.
Lesson 14. Nothing's free. All right, let's talk about one of the harsh truths of investing. Nothing's free. Housel argues that everything worth pursuing has a price, and the key to success is not trying to avoid the price, but being willing to pay it. Think about the stock market. Over the long term, stocks have provided better returns than almost any other investment, but there's a price for those returns. The price is volatility, ups and downs, watching your portfolio drop 20, 30, sometimes 50% during a crash. That's the price of admission. That's the fee you pay for the long-term returns. But here's what people do. They want the returns without paying the price. They want their portfolio to go up every year, and when it drops, they panic. They sell. They try to time the market. They think, I'll just get out during the bad times and get back in for the good times. But that doesn't work, because the price of investing success is volatility, and you can't get the returns without paying that price. Housel uses this metaphor. Imagine you want to go to Disneyland. The price is $60, but you show up and say, I don't want to pay. I'm just going to sneak in. You might get away with it sometimes, but eventually you'll get caught and kicked out, or you'll spend the whole day stressed about getting caught and won't enjoy it anyway. The better approach, just pay the $60, accept that it's the price of admission, and then enjoy the park. Same with investing. The price is volatility. The price is watching your portfolio drop sometimes. The price is uncertainty. Just pay it. Accept it. Don't try to avoid it, because the alternative, trying to time the market or jumping in and out, that costs even more in the long run. And this applies beyond investing. Every worthwhile pursuit has a price. You want a successful career? The price is long hours early on, hard work, dealing with difficult people sometimes, stress. You want a strong relationship? The price is compromise, communication, dealing with conflict, putting someone else's needs alongside your own. You want to be in great shape? The price is disciplined eating, regular exercise, turning down desserts and happy hour sometimes. The problem is we want the results without paying the price. We want the career success without the hard work, the relationship without the compromise, the fitness without the discipline. Housel says that successful people don't have fewer problems. They just recognize that the problems are part of the price, and they're willing to pay it. So the lesson is this: identify what you want, understand the price, and then be willing to pay it. Don't complain about the price. Don't try to avoid it. Just pay it and move forward. And if you're not willing to pay the price, that's okay too. But then don't expect the results. Find something else where you are willing to pay the price. This is such a freeing perspective because it removes the victim mentality. It's not that life is unfair or that you're unlucky. It's that everything has a price, and you're choosing what prices you're willing to pay. Lesson 15. You and me. Let's talk about one of the most dangerous mistakes in investing. It's what Housel calls the you and me problem. Here's the issue. When you're making investment decisions, you have a plan. Maybe you're investing for retirement in 30 years. You're thinking long-term. You're not planning to sell for decades. But when you watch the market, you see prices moving, and you know what's influencing those prices. Other people making completely different decisions with completely different time horizons. You're seeing day traders. You're seeing hedge funds. You're seeing people making short-term bets. They're not investing for 30 years. They're trying to make money this week or this month, and their behavior influences the prices you see. So you look at the market and think, the market is crazy. Why is it moving so much? But the market isn't one thing. It's millions of people with different goals, different time horizons, different strategies, all acting at once. Housel says that bubbles happen when long-term investors start taking their cues from short-term traders. You're investing for decades, but you see momentum traders bidding up a stock and you think, maybe I should buy that too. But their goals aren't your goals. They're trying to flip it in a week. You're trying to hold it for decades. Those are completely different games, and what makes sense for their game might be disastrous for yours. He gives the example of the dot-com bubble. Long-term investors saw internet stocks going up, and they thought these stocks are good long-term investments, but the prices were being driven by day traders and momentum investors who didn't care about long-term value. They were just riding the wave. When the bubble burst, the long-term investors were devastated, but they shouldn't have been playing that game in the first place. They mistook a short-term trading phenomenon for a long-term investment opportunity. Housel says that few things matter more with money than understanding your own time horizon and not being persuaded by the actions and behaviors of people playing different games than you are. If you're investing for retirement in 30 years, you should not care what the stock market does this week or this month. You're not playing that game. Don't take cues from people who are. This is why he advocates for simple, boring, long-term strategies. Index funds, buy and hold. Ignore the noise, because the noise is mostly people playing games you're not playing. And this applies to more than just investing. It applies to career choices, lifestyle choices, financial decisions in general. Don't compare your choices to other people's when they have different goals than you. The person living lavishly and updating their lifestyle with every raise might be playing a short-term status game. You might be playing a long-term financial independence game. Different games. Know what game you're playing, and don't be swayed by people playing different games, even if they look like they're winning in the short term. Lesson 16. The seduction of pessimism. All right, we're getting close to the end, and I want to talk about something Housel discusses that I found really fascinating, the seduction of pessimism. He argues that pessimism sounds smarter than optimism, and there's a reason for that. Think about it. If someone says, everything's going to be great, the economy will boom, the stock market will go up, they sound naive, almost childish. But if someone says, a crash is coming, the system is broken, everything is falling apart, they sound intelligent, sophisticated, like they see something others don't. Why? Housel says it's because pessimism requires little effort. You can just point to what's wrong, and there's always something wrong. But optimism requires a narrative. It requires explaining how things will improve, how problems will be solved. That's harder. That takes work. Also, pessimism appeals to our negativity bias. We're wired to pay more attention to threats than opportunities, so pessimistic arguments capture our attention more easily. And here's the kicker. When pessimists are wrong, they're forgotten. But when they're right, even once, they're heroes. They predicted the crash. They saw it coming. But optimists? When they're wrong, they're mocked. And when they're right, which is most of the time, they don't get credit because gradual improvement isn't dramatic. Housel points out that over long periods, things tend to get better. Technology improves, living standards rise, markets trend upward, but it's slow, it's gradual, it's boring. Meanwhile, crashes and disasters are dramatic and memorable, so we overweight them in our minds. He says this is dangerous for investors because if you're constantly listening to pessimists, you'll never invest. You'll always be waiting for the crash. You'll miss out on years of growth. Now, that's not to say pessimism has no place. You should plan for things going wrong, room for error, remember? But there's a difference between prudent caution and constant pessimism. Prudent caution says, I'll invest, but I'll keep some cash in case of emergencies. Constant pessimism says, I won't invest because a crash is always right around the corner. Housel says you should be optimistic about the long term and paranoid about the short term. Believe that things will generally get better over decades, but plan for setbacks along the way. And be skeptical of pessimists, especially the ones that sound really smart. Ask yourself, are they pointing out real risks I should plan for,
Or are they just being dramatic because pessimism sells? Because here's the truth. Things are always a little broken. There are always problems. But over the long run, humans solve problems. We innovate, we adapt, we improve. That's the optimistic view. And historically, it's been the right view.
Conclusion. Putting it all together. All right, we've covered a lot of ground. Let's bring it all together. Morgan Housel's The Psychology of Money isn't really a book about money. It's a book about human behavior, about psychology, about the gap between what we know we should do with money and what we actually do. And the core message is this: success with money isn't about what you know, it's about how you behave. And behavior is hard. So what do we take away from all this? What are the big ideas we should remember? First, understand yourself. Understand that your experiences shape your relationship with money. Be humble about your own biases and assumptions. Second, recognize the role of luck in risk. Don't assume successful people have all the answers. Don't beat yourself up when things don't work out despite good decisions. Third, define enough for yourself. Get off the treadmill of always wanting more. Decide what success looks like for you, and stop when you get there. Fourth, be patient. Compounding is powerful, but it works slowly. Success isn't about brilliant moves. It's about not screwing up for a long time. Fifth, differentiate between getting wealthy and staying wealthy. They require different skills. Master both. Sixth, prioritize freedom and control over your time. That's the real value of money. Not stuff, not status, freedom. Seventh, save money. Not for specific goals, but for flexibility and options, because you don't know what the future holds. Eighth, be reasonable, not just rational. Make decisions you can stick with emotionally, even if they're not theoretically optimal. Ninth, accept that you'll change. Don't lock yourself into decisions you can't undo. Build in flexibility. 10th, plan for things going wrong. Room for error is the most important part of any financial plan. 11th, understand that everything has a price. Be willing to pay the price of admission for the things you want. Volatility is the price of investment returns. Accept it. And finally, know what game you're playing. Don't take cues from people playing different games with different time horizons. You know, what I love about this book is that it doesn't promise to make you rich. It doesn't give you a formula or a secret strategy. Instead, it gives you wisdom. It gives you a framework for thinking about money in a healthier, more sustainable way. Because at the end of the day, the goal isn't to die with the most money. The goal is to live a good life, and money is just a tool to help you do that. Housel says that the highest form of wealth is living the life you want to live on your terms, with who you want, for as long as you want. And that doesn't require being rich. It requires being smart about money, being intentional, being aware of your own psychology. If you take nothing else from this book, take this. Financial success is more about controlling your ego, managing your expectations, and being consistent than it is about being smart or lucky. You don't need to be a genius. You don't need to pick the right stocks. You don't need to time the market. You just need to save consistently, live below your means, be patient, and avoid stupid mistakes. Do that for a few decades and you'll be fine. Maybe more than fine. It's simple, not easy, but simple. All right, that's our deep dive into The Psychology of Money by Morgan Housel. I hope you found it valuable. I hope it challenged some of your assumptions, and I hope it gave you some new ways to think about money and wealth. If you haven't read the book, I highly recommend picking it up. It's a quick read, it's well written, and it's full of insights we didn't have time to cover today. And if you did enjoy this episode, consider sharing it with someone who might benefit. We all have complicated relationships with money. We all make mistakes, and we could all use a little wisdom in this area. Thanks for listening. And remember, success with money is less about what you know and more about how you behave. So be patient, be humble, be intentional, and focus on what actually matters. Until next time.